Hey there, new business owners. If you're trying to get a handle on your finances, you've come to the right place. Think of me as your guide. Today, we're going to pull back the curtain on the fundamental rules of accounting. It's literally the language your business speaks, and trust me, by the end of this, you'll be speaking it fluently.
So, let me ask you a question, especially if you're just starting out. You've made some sales, you look at your bank account, and there's a nice chunk of cash in there. That's your profit, right? I mean, it seems like it should be, but, and this is one of the biggest hurdles for new entrepreneurs, the answer is almost always no, and we're about to dig into exactly why that is.
To really get why cash isn't the same as profit, you have to learn the basic grammar of accounting. And it all starts with two golden rules that form the foundation of everything.
Okay, first up, the business entity concept. This is so important. You have to think of your business as its own person. It is completely separate from you. So when you put your own money into the business to get it started, it's not just moving from your left pocket to your right pocket. No, from an accounting point of view, the business now owes you that money. This separation is absolutely the first step to getting real financial clarity.
And the second golden rule is duality. Think of it like Newton's third law, but for money. For every action, there's an equal and opposite reaction. It means that every single transaction, and I mean every one, has a two-sided effect. There's always a give and a take. Something is gained, but something is also given up. This is the magic that keeps the whole system in perfect balance.
In this right here, this is how you visualize that perfect balance. This is the fundamental accounting equation. On one side, you have your assets. That's all the stuff the business owns. And on the other side, you have what the business owes. That's split into liabilities, what it owes to outsiders, like a bank loan, and capital, which is what it owes back to you, the owner. And here's the key. Both sides always have to be equal. No exceptions.
Okay, theory is one thing, but let's make this real. Let's walk through a super simple everyday business transaction to see this duality concept in action.
This is a perfect illustration of duality. Let's say the business buys a new computer. What happens? Well, its assets in the form of equipment go up, but at the same time, its assets in the form of cash go down by that exact same amount. See? The total value of what the business owns hasn't actually changed. It's just shifted from one column to another. The equation stays perfectly balanced.
All right, so let's get back to our big question from the beginning. If the cash in the bank isn't our profit, then what is? This is where we really start to see why just looking at your bank statement can give you a totally warped picture of how you're doing.
There are basically two ways to look at your finances. There's the cash basis, which is super simple. Money comes in, you record it. Money goes out, you record it. It's fine for maybe a small side hustle, but then there's the accrual basis. And this tells you the real story. It records revenue when you've actually earned it, like when you've delivered the service, not just when the client's check clears. For any business that's serious about growth, this method gives you a much more accurate picture of your financial health.
Now take a look at this chart. It's fascinating. On a cash basis, this business looks like it had an amazing month. A huge check from a client came in, so profit looks sky high. But the accrual basis tells a completely different story. It takes that big payment and matches it with all the expenses from the last few months that it took to earn that money. The result? A much lower but far more realistic profit. That's the number that tells you how you actually performed.
So accrual accounting is really built on two powerful ideas working together. The first is the revenue recognition principle, which just says you count the money when you've done the work, not when you get paid. The second is the matching principle, which says you have to line up your costs with the revenue they helped create. When you put those two together, you get the true story of your profitability for any given period.
Now, of course, for any of this to mean anything, you and your bank and your investors have to be able to trust the numbers. Everyone needs to believe the data is real and reliable. And that's where our next set of principles comes into play.
First up is consistency. This is a big one. You can't just change how you do your books whenever you feel like it. Why? Because you'd never be able to tell if you're actually growing or not. Using the same methods year after year ensures that you're making a fair apples-to-apples comparison. It lets you see real trends over time.
Next, we have objectivity. This basically means show me the proof. Every single number in your books has to be backed up by something real and verifiable. An invoice, a receipt, a bank statement. This makes sure your financial records are based on cold, hard facts, not just someone's opinion or guess. It's why we always record assets at their original cost. It's a number we can actually prove.
I love this quote. It perfectly sums up the idea of conservatism, or what some people call prudence. It's really just a play-it-safe approach to your books. It means you should account for expenses and potential losses as soon as you think they might happen. But on the flip side, you only record revenues when they're pretty much a sure thing. This keeps you from overstating your profits and making bad decisions based on money you don't actually have yet.
So why all these rules? I mean, why can't every business just do its own thing? Well, imagine trying to play a game where everyone has a different rule book. It would be chaos, right? It's all about creating a level playing field so that everyone is speaking the same financial language. And that common language has a name: Generally Accepted Accounting Principles, or GAAP. You can just think of it as the official rule book for the entire game of accounting. It makes sure that all financial reports are prepared in a consistent way so that anyone, investors, banks, you name it, can compare different companies fairly and make smart decisions.
And you should know, this rulebook isn't some ancient text carved in stone. It's a living, breathing document. It evolves over time based on what's happening in the world. Big economic events happen and new rules get created. Professional groups of experts are constantly developing new guidelines, and governments step in to pass laws to protect people. It's always changing to stay relevant.
Okay, I know we've covered a ton of ground. So let's do a quick-fire recap of all the essential tools you now have in your accounting toolkit to understand your business.
Let's run through the foundational concepts. Ready? Your business is a separate entity. We only measure things in money. We assume it's a going concern, meaning it's not shutting down tomorrow. We report results in set accounting periods, record assets at their original cost, and remember, every single transaction has duality, that two-sided effect.
And for accurate reporting, you recognize revenue when it's earned, and you match expenses right alongside it. You practice full disclosure, telling the whole story. You maintain consistency in your methods. You use conservatism, that play it safe rule. And finally, you focus on what's material or important, and always remain objective.
All right, pop quiz time. Let's see what you've picked up. That concept that a business will keep operating and isn't about to be liquidated. What is that called? Is it A, going concern, B, economic entity, or C, monetary unit? If you said A, going concern, you got it.
Okay, one more for you. What do we call the idea of recognizing expenses in the exact same period as the revenues they help to create? Is it A, consistency, B, matching, or C, conservatism? The answer is B, the matching concept. Awesome job.
So we've come full circle. You now know for sure that profit is so much more than just the cash sitting in your bank account. It's the full, detailed story of how your business is actually performing. And now that you understand the language of accounting, you have the power to read that story, make smarter decisions, and best of all, you get to decide what story your business is going to tell.